So, sir, when I met you for the first time in 2014, I asked you this question inspired by Peter Thiel's 0 to 1. What important truth in investing do very few people agree with you on? And you replied at that point of time, paying up for quality. If I ask you the same question today, will you answer the same, or it will change given how some of the quality companies are valued today by the market?
So that's the interesting question, and my answer is the same. By the way, very short answer to your question is the answer is not changed, but the context is important. So when we last talked about it, and I have written about it, spoken about it, the basic idea was that there is this school of value investing called deep value investing, where you are spoiled by a wonderful teacher like Ben Graham, and his idea of investing was to invest in businesses that have stocks which are valued at below liquidation value in many cases, or at extremely low multiples of their normal earning power. And he wrote his book coming out of the Great Depression. 1934 was the first edition of his book Security Analysis, and he was very paranoid about protecting the downside risk. And so I had been teaching this subject for a long time, and in 2014 when we talked about this subject, it had been almost 3 years, and I had sort of transitioned over towards the other side of value investing, which is the Philip Fisher philosophy, which we all know is followed by so many investors around the world, including Warren Buffett and Charlie Munger. So in that context, I said, well, you should pay up for quality, but the key thing here was that you are still a value investor, which means you don't want to overpay for anything. So what I meant then, and what I stand by, what I said then was uh, that there are these businesses which have some unique characteristics, and they should be distinguished from the ordinary business. The ordinary business has no competitive advantage, has no pricing power. It tends to earn a mediocre or poor returns on capital over the long term. It has usually a levered balance sheet. Now, that doesn't mean that these businesses have no value. Of course, it does have value, but the way to value such a business is not the way to value a high quality business. So that was the distinction that I was making when I said pay up for quality. Um, but since then there is a new term that has been coined, and it's called buy at any price, BAAP, and that's sort of ridiculous in my view. And I've talked about it in the recent past. I never bought into that idea of buying at any price. Paying up doesn't mean that there is no limit to the price that you will pay for an asset, because it's even ridiculous to even try to rationalize it. It's sort of mathematically foolish to even try to justify BAAP, buy at any price. I mean, if you think about it, the total return on a stock that you own, that you buy today, and if you expect to hold it for like 5 years, 7 years, 10 years over your expected holding period, the total return will come from only four variables. And those four variables are the entry multiple of earnings, the growth in earnings that will occur over your prospective holding period, the dividends that will come out of that, and the exit multiple. Because the exit multiple combined with the earnings 10 years out or 5 years out or 7 years out, whatever your holding period is, will determine the exit stock price. So you will have the exit stock price compared to the current stock price, that will give you the capital gains, and then you have the dividends which are there. So these are the only sources of return that you will have. And uh, and if you change just one variable, which is the entry variable, entry multiple, by jacking up the price, then you plug these numbers in an Excel model, then obviously if you increase the entry price, the total return goes down, because the total return, the other things, earnings growth, the dividends that will come out of those earnings, that will grow, or the exit multiple, are sort of independent of the entry price that you pay. So the more you pay, the less the return that you will make. It's so obvious, it's so mathematically obvious, right? And if you keep increasing the price, at some point the return becomes zero, and if you do keep going, then it becomes negative. And another way to think about it is in terms of margin of safety, right? We all know the idea of margin of safety, which is the difference between perceived value and and price paid for a stock. If you keep increasing the price paid, the margin of safety must come down and then it becomes zero, because the value is independent of the price. The value of a stock is nothing to do with the price that you paid for it. So the more you pay for it, the less the money you should make, and you can overpay for it and then you should lose money. And that's exactly the logic behind thinking about it in terms of mathematics. Now, the thing is that the concept of BAAP can is like any other fad. It can have it can produce extraordinary returns for a period of time, and then people start thinking, well, this is the way to do it. And it might have worked for a while, but it is not logical, right? It's not nothing to do with underlying value. So people who have paid very high P multiples for mature businesses, I'm not talking about businesses that are going to grow and grow and grow, like businesses which are still in the very high growth stage. Theoretically, you can pay a high multiple of the current earnings because earnings are going to grow very rapidly. But there are a whole bunch of businesses in India which are very valued very highly, which are of excellent quality, no doubt. They have great business models. They have wonderful people who run those businesses in terms of their operating skills, the capital allocation skills, and the integrity. But they're mature businesses, which means that their future growth is not going to be anywhere close to the growth that they have seen in the past 20 or 30 years. These businesses have been around for a very long time, but they tend to get sold at very high prices. Maybe because there is scarcity value, maybe because governance is a concern here. I don't want to go into the reason why that had happened, because that will try to justify what markets do. But the point I'm making is that if you're paying a high multiple for a very mature business of high quality, you will only make money if the multiple does not contract over time. And that's something which almost always happens. I mean, look at the world around you. Google, by the way, Alphabet is currently selling at a P of 20. As businesses become mature, their growth rates must come down, and P multiples 10 years out, 15 years out must factor the growth beyond that period. So if forward growth rates will come down, which will always happen, then multiples must contract. And if you are paying 80p multiple for a business today, which will be valued at 20, 25, maybe 30p multiple 10 years out, then you're looking at a contraction of multiple from 80 to 30 over 10 years. Then the only way that can be offset for you to make money is to have earnings growth which is so extraordinary that it more than offsets the reduction of return that will come because of the reduction of the multiple. And that's a very dumb assumption to make, because we are, as I mentioned, if a business is mature, the earnings growth rate is not going to be extraordinary. If the earnings growth rate is not going to be extraordinary, then the forward multiple must be a normal multiple, mid-teens, maybe low 20s, not more than that. Any model that assumes exit multiples many years out for a mature business to be more than 20, 22, 23, maybe 25 max is something which I think is absurd, and it's foolish assumption in my view. So again, going back to the point that you were asking, pay for quality in comparison to deep value businesses, mediocre businesses, commodity businesses, businesses which have poor returns on capital. But don't make the mistake of paying up too much for a mature business, because then you have a very high risk of having a permanent impairment of capital in the long run.